Stop. Right now. If you're thinking about selling your silver at $80, you're about to make the biggest financial mistake of your life. And I can prove it. Bank of America just released a research report that changes everything. The same Bank of America that has been bearish on precious metals for years. The same institution that told people to sell gold at $1,200. They just flipped completely bullish. And when the biggest bear becomes a bull, you need to pay attention. Here's what they're not telling you on mainstream media. That $80 price you see on your screen, it's fake. It's a paper price. Meanwhile, if you try to actually buy physical silver right now, dealers are charging $90 to $100 per ounce. That's a $20 difference between paper and reality. And here's the nuclear bomb. Western banks are short 4.4 billion ounces of silver. That's 5.5 times the entire world's annual mining production. And Bank of America just said a historic short squeeze is now inevitable. If this sounds important, hit that like button right now and subscribe. Because the next 12 minutes will show you exactly why $80 is a trap and where silver is really headed. Let's go. Let me start with the most important piece of information. Bank of America just published a metals research report that has shocked the entire financial community. They are now projecting gold to hit $4,500 per ounce. But that's not the crazy part. The crazy part is they're recommending that investors allocate 20 to 30% of their entire portfolio to precious metals. 20 to 30%. Let me put that in perspective. The traditional Wall Street advice is 0 to 5% in gold and silver, maximum. It's considered a small hedge, a tiny insurance policy. But Bank of America just said you should have up to 30% of your wealth in metals. Why does this matter? Because Bank of America doesn't just manage money for retail investors like you and me. They manage money for billionaires, for institutions, for pension funds. When they tell their clients to put 30% in metals, trillions of dollars will follow that advice. Now here's where it gets interesting for silver. Bank of America didn't just give a gold target. They analyzed the historical gold to silver ratio. And based on that ratio, they calculated where silver should be. In 2011, when silver hit its previous peak, the gold to silver ratio was around 30 to 1. If we apply that same ratio today with gold at $4,500, silver should be at $135 per ounce. But Bank of America went further. They said in extreme scenarios, if we see the kind of monetary chaos they're expecting, the ratio could go even tighter. And that's where their implied target of $309 per ounce comes from. $309. That's not some random YouTuber predicting crazy numbers. That's Bank of America, one of the largest financial institutions in the world. Now, you might be thinking, banks always make big predictions to get attention. Fair point, but this is different. Let me explain why. Bank of America has been bearish on precious metals for over a decade. In 2013, they told clients to sell gold. In 2015, they said silver was going to $20. In 2020, they were still negative on metals. They were wrong. Completely wrong. And now they're admitting it. They're not just making a bullish call. They're completely reversing their entire thesis. In trading, there's a concept called bear capitulation. It's when the last holdouts, the biggest bears, finally give up and turn bullish. And historically, that's when the real move begins. Because if even the bears are buying, who's left to sell? Think about it like a tug of war. On one side, you have bulls pulling the rope toward higher prices. On the other side, bears pulling toward lower prices. As long as there are strong bears on the other side, the rope moves slowly. But when the bears let go of the rope and run to join the bull's side, what happens? The rope and the price flies upward with no resistance. That's what's happening right now with Bank of America's flip. The biggest institutional bear just joined the bull side. And that's terrifying for anyone who's short silver. But Bank of America didn't just flip bullish because of sentiment. They're seeing something in the supply data that's genuinely scary. Global silver mining production is declining by 2% annually. That might not sound like much, but in a market that's already in deficit, 2% is massive. Why is production falling? 3 reasons. First, energy costs. Mining is incredibly energy intensive. You need massive diesel generators, electric equipment, processing facilities. With energy prices elevated, mining costs have exploded. Second, labor and equipment costs. There's a global shortage of mining equipment and skilled labor. Lead times for mining trucks are 2 years. Experienced miners are retiring faster than new ones are being trained. Third, ore grades are declining. This is critical. 30 years ago, miners could pull high-grade silver ore from shallow deposits. Now they're going deeper, processing lower-grade ore and spending more money for less silver. Bank of America's research shows that at $70 per ounce, many silver mines are barely breaking even. Some are operating at a loss, hoping prices rise. If prices fall, these mines shut down, and if prices stay flat, there's zero incentive to open new mines. Here's the scary math. It takes 7 to 12 years to open a new silver mine from discovery to production. Even if silver hits $200 tomorrow, we won't see meaningful new supply until 2033 at the earliest. Meanwhile, demand is exploding. Solar panels, electric vehicles, 5G infrastructure, data centers all need more silver every year. The Silver Institute projects demand growing 50 to 60% by 2035. So we have falling supply and rising demand. That's not a recipe for $80 silver. That's a recipe for explosion. Now let me tell you about the elephant in the room that Bank of America is watching very carefully. China. China has expanded its M2 money supply by 48 trillion yuan. That's roughly 6.7 trillion US dollars. They printed this money over the past few years, and now they need to do something with it. Here's the problem with printing money. It loses value over time. It's like ice melting. The longer you hold cash, the less it's worth because of inflation. So smart players don't hold cash, they convert it into real assets. And China is doing exactly that. They're buying oil, copper, agricultural products, and massive amounts of gold and silver. They're converting worthless paper into physical commodities that will hold value. But here's what makes China different from normal buyers. Normal buyers stop when prices get too high. If silver hits $100, regular investors say, that's too expensive, and stop buying. China doesn't care about price. They care about getting rid of yuan before it loses more value. They can print unlimited yuan. So even if silver hits $150, $200, $300, China can keep buying. They're not buying to make profit. They're buying to preserve wealth. This creates what traders call a bottomless bid. No matter how high the price goes, there's always a buyer. And that's absolutely terrifying if you're short. Think about it like this. Imagine you're selling bottles of water in a desert. Normally, if you charge $10, people might say no. But if someone has a printing press and can print unlimited $10 bills, they'll pay any price. $20, $50, $100, doesn't matter. They need the water and money is infinite for them. That's China right now with silver, and Bank of America knows it. And now we get to the nuclear bomb in this story, the short position. Western banks, JP Morgan, Citibank, and others, are collectively short 4.4 billion ounces of silver. Let me repeat that. 4.4 billion ounces. The entire world mines about 800 million ounces per year. That means these banks have sold short 5.5 times annual global production. Most of these short positions were taken when silver was between $20 and $25 per ounce. The banks were betting silver would fall. They sold contracts promising to deliver silver at lower prices, but silver didn't fall. It's now at $80. And here's the math that should terrify you if you're one of these banks. For every $1 move up in silver, these banks lose $4.4 billion in mark-to-market value. Silver has moved from $25 to $80. That's a $55 move. Multiply 55 times 4.4 billion, that's $242 billion in paper losses. Now, as long as contracts settle in cash, banks can handle paper losses. It's painful, but manageable. But what happens if counterparties demand physical delivery? Here's where it gets catastrophic. COMEX vaults hold roughly 500 million ounces of silver total, but only about 180 million ounces are actually available for delivery. The rest is tied up in other obligations. If even 10% of contract holders demand physical delivery, we're talking about 440 million ounces. But there's only 180 million available. The math doesn't work. What happens when you can't deliver? You have to go into the open market and buy silver at any price to fulfill your contracts. And when multiple banks are trying to buy hundreds of millions of ounces simultaneously, the price doesn't go up steadily. It goes vertical. Bank of America used the phrase extinction level event in their analysis. Not market correction, not bear market. Extinction level. That's the language you use when you think something could completely blow up. So now we come to the most important part of this video, the $80 trap. If you own physical silver right now, banks need you to sell, desperately. They need your ounces to cover their short positions. But they can't just call you and say, hey, we're in trouble, please sell to us. Instead, they do something clever. They use their high-frequency trading algorithms to keep the paper price pinned around $80. Not 70, not 90, right around 80. Why 80? Because $80 feels really high to most people. If you bought silver at $25, you're up 220%. Your brain is screaming, take profits, this is the top. Sell before it crashes. That's the psychological trap. They're making $80 feel like the peak, so you voluntarily sell. But here's how you know it's a trap. Go try to buy physical silver right now. Call any major dealer, ask for American Silver Eagles or silver bars. They'll quote you $90 to $100 per ounce. Some dealers are even higher. The premium overspot is $15 to $20. In a normal market, premiums are $2 to $3. When premiums are $20, it means one of two things. Either demand is insane or supply is extremely tight, probably both. This is called decoupling. The paper price and physical price are separating, and when that happens, the paper price is lying. The real price is what you have to pay for actual metal in your hand. So when you see $80 on the screen, understand that's not the real price. That's the price banks want you to believe, so you'll sell to them. The real price is closer to $100, and Bank of America thinks it's going to $300 plus. If you sell at 80, you're selling a winning lottery ticket for the price of a sandwich. Let me tell you who's buying silver at $70, $80, $90 right now, because this will tell you everything. First, China. As I mentioned, they're buying unlimited quantities. Price doesn't matter. They're swapping yuan for physical assets. Second, Pentagon and US military. Silver is critical for defense systems, missiles, radar, communications, solar panels for military bases. The Department of Defense is stockpiling because they know supply chains are fragile. Third, solar manufacturers. Every solar panel needs silver. With the green energy transition, solar installation is projected to triple by 2030. These companies have no choice but to buy silver at any price. If they don't, they can't build panels. Fourth, central banks. Not just China. Multiple central banks are adding silver to reserves. Why? Because they see the same thing Bank of America sees. The monetary system is unstable, and real assets will outperform paper. Now ask yourself, if these sophisticated players, governments, military, industrial giants, central banks, are buying at $80 and higher, why would you sell? The only sellers right now are retail investors who are scared of a correction and banks trying to cover shorts. That's it. Every sophisticated player is on the buy side. Let me take you back to 2011. Silver ran from $18 in August 2010 to $49 in April 2011. That's a 172% gain in 8 months. At $49, everyone said it was over. Silver's too high. This is the bubble top. Sell now or lose everything. Then silver crashed to $26 by September 2011. Everyone who sold at $49 felt like geniuses. I called the top perfectly. But here's what happened next. In the following years, silver based around that level and then began another major cycle. And now, in 2025 to 2026, we're at $80. That's 63% higher than the bubble top of 2011. The difference is this. In 2011, we didn't have the supply crisis we have now. We didn't have China printing 48 trillion yuan. We didn't have the green energy transition requiring a massive silver quantities. We didn't have Bank of America calling for $300 silver. 2011 was a warm-up. This is the main event. Now, let me address the obvious question. What if silver crashes back to $60? Shouldn't I sell at $80 and buy back cheaper? Here's the problem with that strategy. You might be right. Silver could correct to $70 or $65 in the short term. Markets don't go straight up. But what if you're wrong? What if the short squeeze starts while you're sitting in cash? Let me paint the scenario. You sell at $80, feeling smart. You're waiting for a dip to buy back. Then Bank of America's report gets picked up by mainstream media. Suddenly, millions of retail investors want silver. They rush to dealers. Dealers are already low on inventory. Premiums spike to $30. The paper price jumps to $95 in 2 days. Now you're sitting in cash, watching silver at $95, waiting for it to come back to $80. But it doesn't. It goes to $110, then $130. The squeeze is happening and you're on the sidelines. Could you buy back in at $95? Sure, but psychologically, it's almost impossible. Your brain will tell you, I just sold at $80. I can't buy back at $95. That means I lost $15 per ounce. So you wait, and watch it go to $150. This is what happens to traders who try to time tops in short squeeze situations. They get left behind. I'm not saying silver can't correct. I'm saying the risk of missing the squeeze is much greater than the risk of riding through a temporary dip. Here's the mindset you need to adopt if you own physical silver. Think like a central bank, think like China, think like the Pentagon. They're not traders. They're not trying to sell high and buy low. They're accumulating strategic assets for the long term. They buy at $70, they buy at $80, they'll buy at $90. Price is secondary to ownership. Why? Because they understand that in a world where governments are printing unlimited currency, the value of paper goes down and the value of real assets goes up. It's that simple. When China buys silver at $80, they're not thinking, I hope this goes to $100 so I can make $20 per ounce profit. They're thinking, I'm converting currency that loses value every day into a physical asset that will hold value forever. That's the difference between a trader and a strategic buyer. Traders worry about short-term price. Strategic buyers worry about long-term ownership. If you own physical silver, you're not a trader. You're a strategic buyer. Act like it. Now let's talk about timing. Why did Bank of America release this report now? Why not 6 months ago? Why not 6 months from now? Major institutions don't release research randomly. They release it when they're positioned, when their clients are positioned, when they're ready for what comes next. My interpretation? Bank of America and their clients have finished accumulating. They're long. They're ready. Now they're telling the public because the next phase, the squeeze, benefits them if more buyers enter. This is how big money works. Accumulate in silence. Then broadcast your thesis when you're ready for the price to move. The fact that they're going public with a $309 target tells me they think the move is imminent, not years away, months, maybe weeks. Let me be clear, I'm not a financial advisor. This is not financial advice. I'm sharing information and analysis. You must make your own decisions. But here's what I would consider if I were in your position. If you own physical silver that you bought below $50, don't sell. You're holding a strategic asset that major institutions believe will triple or quadruple. Why give that up for an $80 payoff? If you're thinking about buying silver now at $80, understand the risks. Short term, there could be volatility. But long term, Bank of America's thesis suggests significant upside. If you're going to buy physical, not paper ETFs, not futures contracts, physical metal in your possession. Because if the short squeeze happens and COMEX can't deliver, paper silver holders might get cash settled at unfavorable prices, while physical holders have the actual metal. And most importantly, ignore the noise. You're going to see articles saying silver is overpriced. You'll see analysts calling for a crash. You'll feel pressure to sell. That's all part of the $80 trap. Remember, Bank of America, one of the largest financial institutions in the world, just said silver is going to $309. They're telling their billionaire clients to put 30% of their wealth in precious metals. That's not a casual recommendation. That's a massive call. Let me wrap this up, because this is critical. $80 is not the top. It's not even close. It's a trap designed to shake out retail holders so banks can cover their 4.4 billion ounce short position. Bank of America just confirmed what many of us have been saying for months. The supply crisis is real. The demand surge is real. The short position is unsustainable. And a historic squeeze is inevitable. Their target of $309 isn't a joke. It's based on the gold-silver ratio, monetary expansion, supply-demand fundamentals, and the magnitude of the short position. China is buying with 48 trillion yuan of printed money. The Pentagon is stockpiling. Solar manufacturers are securing supply. Central banks are accumulating. These sophisticated players are buying at $80 and higher. The only question is, are you going to sell your lottery ticket for the price of a sandwich, or are you going to hold for the $300 payday? If this video opened your eyes, smash that like button. Subscribe for more deep analysis, and share this with anyone you know who owns silver. Comment below, are you holding or selling at $80? I want to know your strategy. I read every comment. This is the biggest trade of the decade. Don't let them shake you out right before the squeeze. Stay strong, stay informed, and I'll see you in the next one.